Yes.
Okay.
Hello, everyone. Good afternoon, good evening, and early good morning if you're in the Asian Pacific area. So today is our number 17 public lecture on corporate governance. So let me introduce this series first. Let me share my slides. Okay. Sorry, I mean to share my slides. All right, so my name is Jun Yang. I'm the director for the Institute for Corporate Governance at Kelley School of Business at Indiana University. Kelley ICG was actually founded a long time ago in 2004, and our main mission really is to conduct and disseminate high-quality research on corporate governance. And we have hosted a whole series of public lectures on corporate governance since November 2021 to focus on important issues, including the classic questions like corporate board, CEO compensation, shareholder activism, so on, and new challenges and opportunities presented by data and technology. So I'm going to show you the slides of past lectures in one slide. And the goal mainly is to facilitate the discussions and debate of important governance issues, hoping to inform policymakers and guide our young scholars in their research in the near future. So the series is co-hosted by the ECGI and Ostrom Workshop at Indiana University. So the next slide is our past lectures. I'm trying to turn it. So we cover the traditional ones like board of directors, exec compensation. We also look at investor side, hedge fund activism, indexing, and next month we have shareholder voting. And in addition, we cover insider trading, white-collar crimes, and corporate culture. And on the new topics, we have ESG, that's one lecture, sustainability, another lecture, greenwashing, that's coming up in December. And we have climate risk covered early in the spring. And on data and technology, we have one lecture purely on data technology and the impact on corporate governance. And we talk about cybersecurity, data ownership, cryptocurrency, blockchains, and their impact on governance. We also have kind of occasional topics such as cocoa bonds when the banking crisis or banking episode showed up early in the spring. So for this fall 2023 series, today we have CEO markets, public versus private firms. We have two distinguished scholars. Each of them could cover 3 lectures of mine talking about CEOs. I'm not exaggerating at all. So Steve Kaplan from University of Chicago and Dirk Jenter from LIC. So I will be the moderator for today's fireside chat. This is a new experience for the ICG lecture series. Next month, we have Nadia Malenko from Boston College to talk about shareholder voting. In December, Petro Meadows will cover greenwashing and impactful investments. So before I move on to today's speakers, let me do one ad. This is the barcode you can scan, take out your devices. This shareholder voting on October 5th by Nadia Malenko. I'll give you 20 seconds. All the recordings are available on our website. And if you search for Kelley ICG blog, all the public lectures are there. All right, without further ado, today's speakers, sorry, not speaker. I will start with Dirk. Dirk graduated from Harvard in 2002, and then he worked at MIT, then Stanford. So he returned to London School of Economics, or joined London School of Economics in 2015. Dirk is the CPER Research Fellow. He was the NBER Fellow before he returned to London. And Dirk is an expert on corporate finance and corporate governance specifically. Dirk has multiple projects on CEO replacements and CEO hiring, CEO compensation. He has both theoretical and empirical research on various topics related to CEOs. He has survey papers on the research in the past 20, 30 years. He also conducted surveys on CEO-related issues and hearing the voice directly from investors and the board of directors. Dirk has been the associate editor on various prestigious journals such as JF, RFS, and he serves on multiple committees of prestigious professional associations such as WFA, AFA, and EFA. So that's about Dirk. He can give us a lot about CEOs. And the other speaker, I don't think you need an introduction about Steve. Professor Steve Kaplan, also graduated from Harvard, a little bit some years before Dirk. And Steve joined Chicago in 1988 and stayed there since. Steve is an expert on entrepreneurship, private equity, venture capital, as well as corporate finance and corporate governance, especially CEO compensation. So Steve is characterized by a Fortune article as probably the foremost private equity scholar in the galaxy. So I agree with that completely. I can use very similar description of Steve about his research on CEO compensation and managerial talent in general. So not only these substantial academic achievement is worth mentioning, but also Steve educated a generation or maybe generations of outstanding scholars in finance. So here's a small personal story. Steve has helped me in every single step of my career advancement, starting from including my research on CEO compensation peer benchmarking in the 2008 AFA meeting. On top of that, Steve pointed out the junior co-author, which was me, even though both authors are assistant professors, should present a paper at the meeting. That's exactly what I did. And because of that, there's a whole series of events, very extensive positive externality that made me who I am today, that made me a scholar of what you see today. So Steve, I owe you for many things you have done for me and for the rest of the profession. Thank you. All right, so that's a long introduction.
Great to hear. Wow.
Here is the motivating chart. I got it from Dirk. We talk about CEO markets, and actually there are two papers, one written by Steve and his co-authors, one written by Dirk and his co-author. The names are very similar, actually. One is called The Market for CEOs, Evidence from Private Equity, and the other one called The Market for CEOs. Dirk focused on the market for the publicly traded companies, especially S&P 500. And looking at this small table, what you find is for the S&P 500 firms, only very small fraction are external hires. If you flip this part to see how big is the fraction of internal promotions within the S&P 500 firms to the CEOs, that's more than 3/4. Dirk would walk you into, if you refine the definition of internal versus external hires, especially if you exclude former employees and former directors, then you will have the external hires down to about 20%. It's either 19 or 20%, depending on the sample period you're looking at. So in short, most CEOs for public traded companies, especially the large ones, are hired or promoted internally. On the flip side, Steve has a paper looking at companies backed by private equities. And for that group of firms, external hires are the vast majority, around 3/4, 75% of them are hired from outside the company. And even use the most stringent definition, that's still more than 2/3 of CEOs coming from outside. So then there's a natural question. Why this is the case? Why private companies and public companies hire CEOs so differently? What are the economic forces behind it? So that's the main thing about today's discussion. I will leave the podium to you. Steve, let me stop my sharing. Would you like to start with the private company side? Thank you.
Great. Well, thank you very much for the nice introduction, and I'm glad to hear the AFA meetings were useful and impactful, since I'm going again this year for the first time in a while. So I'll pay special attention after hearing that. So thanks. I'm going to give you some thoughts on the CEO labor market, and again, I'm going to focus on the private side, and then Dirk is going to focus on the public side. So the motivation for this was that existing research on the CEO labor market really focused almost exclusively on public companies, and in particular, Dirk's paper was a motivation for this. That we saw his results, and we kind of having taught private equity for a long time. And I know they hire, I knew they hired outsiders. I was interested, or Paul Vladimir and I were interested in figuring out, well, how often do they hire insiders? And it's also important, and I'll give a little tutorial on the private equity market, but the private equity market, as most of you know, has grown markedly over the last 40 years. And I'll give a sense of how big that growth is. So, we already heard about the paper that Dirk co-authored, and I'll leave it to Dirk to talk more about that, and Jun already has. So this is a graph of private equity assets under management over time. And in 2000, it was less than $1 billion. In 2021, it was over 10 billion. I think if you do this now, it's probably over 12 billion, and this is private capital, and private equity is 2/3 of that. So lots of that's trillion, not billion, excuse me. So it's 12 trillion and 8 trillion in private equity. So it's a big asset class, and this just shows you commitments to private equity partnerships in the US. So this is just buyout. It doesn't have growth equity or venture, and they've been running like $300 billion a year. And even if you do it as a fraction of the stock market, which is probably a better way to look at it, it's sort of, it was kind of smallish here. It's been running about, 0.8% of the US stock market every year. So let's sort of get a sense of how big that is, typically you raise money in a year, it takes you 5 years to spend it. So you kind of want to figure out the stock of private equity is about 5 years. So that's about 4% of the total stock market. And, a typical deal is probably 40% equity and 60% debt. So 40% equity, 4% of the stock market, you're talking about value of portfolio companies of about 10% of the stock market. There's co-investment, meaning money is coming from other investors. That's maybe 25%. So that would get you to 12.5% of the stock market. Sometimes insiders, retain some shares. That would make it higher. This is just for private equity and buyout. If you stuck in growth equity, infrastructure, venture capital, it would be higher. So you might have, you add it all up, it might be 20% of the stock market, which would be, it's not the whole economy. I don't know, the public stock market, what that is of the economy, but private equity is basically a big, it's a big asset class, and it's grown quite a bit, and we'll see what happens in the future. But that's why it's worth studying. It's a non-trivial part of our economy. And if you look at returns to private equity, private equity performance has been attractive. That's why money has flown to it. And I'll give a sense of the performance. This just shows you over time, if you put money in a private equity fund, how much money would you get back over the life of the fund? And you can see it's sort of 1.5 to 2 times. It's been about 2 times post the great financial crisis. So you get back, you put in $1, you get back $2 over time. And that's attractive to investors. The question, you also want to ask is how do they do relative to public markets? And that's what you see here. The black is the performance of the average fund raised in a given year. And this is relative to if you just put your money in the stock market at exactly the same time that you put money into the buyout funds. And what you can see is that over the life of the fund, every vintage year since, actually in existence since the early 90s has beaten the S&P 500. And that shouldn't happen. It's a strain, and maybe won't happen in the future, but this is the performance over time that has led money to go into private equity. So this is just an introduction to say, why did I study, or why did we study private equity funded companies in addition to public companies? Is number one, it's a big asset class, represents a decent fraction of the economy. And number two, they've performed very well historically relative to public markets. And I should add, this is net of fees. So gross of fees, the performance would be even better. Okay, so what did we look at? We looked at buyouts that were big. They were worth more than $1 billion from 2010 to 2016. And because we wanted to at least have some comparison to public companies. So these are not as big as S&P 500 companies, but they're actually pretty comparable to S&P 400 mid-cap companies. So that's what we're basically looking at here. And many of the deals had a CEO change. So we looked at after the deal was done, we followed them through various sources, LinkedIn, PitchBook, just web searches. And almost 3/4 of the deals had a CEO change. And then another 28% had a second CEO change. So, we have roughly as many CEO changes as companies. And what did we find? As Jun said, that the new CEOs were overwhelmingly outsiders, the 76% external and 66% or 67% were true outsiders. And then we looked at the second, if they replaced the CEO a second time, we basically got the same result. It was outsiders or external. Now, the thing that's worth mentioning when you're talking about markets is where did these CEOs, the external ones, come from? And it turned out that 2/3 have public company experience and almost half had S&P 500 experience. So for the first external CEOs, they are sourcing from public companies rather than from just private companies. And it was a little bit lower for the second external CEOs. There were more coming from private equity funded companies. The other result about the CEOs that, they had public company experience, the thing that's just, striking and sort of incontrovertible is even though they were external, they basically came from the same industry. So, basically 79% had experience in the same industry for sure. Another 7%, 10% looked like you couldn't nail it down with an SIC code, but they looked pretty similar. So it's basically 85 to 90% of these external CEOs did come from what looked like the same industry. And the last thing we did in this paper is we tried to figure out how much money did these CEOs make that we can then try to compare to public company CEOs. And So I went through, figured out how the deals did in terms of performance, had some estimate of how much stock the CEOs get, and the estimate is 2 to 3% of the company is what these CEOs tended to get in terms of equity upside. Estimated their cash compensation, which looked like it was about $2 million a year in cash compensation, added it all up, and basically got that our estimate of what these CEOs make is somewhere between $9 and $13 million a year. And we compare that to an S&P 500 CEO, which depending on your measure of compensation is 11 to 17. So it's a bit lower than an S&P 500 CEO, but it's much higher than a mid-cap 400 CEO. So just summarizing, the CEOs are paid quite well, and somewhere between a mid-cap and a large cap CEO. So that's the bottom line. External hires, a lot of public company experience, industry experience, compensation is attractive. So what can we conclude? We basically conclude firm-specific human capital is relatively unimportant, that because industry matters, but not company experience, there appears to be a market for CEOs that's external. And, industry-specific skills are very important. Another thing that, maybe Dirk will talk about, I went to a conference with right before the pandemic started. Actually, the pandemic had started. It was February of 2020. I went to a conference that Alex and Dirk were at, and talked about their work. And they also, subsequently wrote a paper. And at this conference, it was very clear, like in Europe, the institutional investors did not like paying public company CEOs what they were paying them in the UK. And of course, the UK, they make less than they do in the US. And what this says is that it's kind of dangerous, because the public company CEOs do have an option to go to private equity funded companies and get paid. So that's my conclusion. Why are the results so different is an open question, which I think we will talk about. And I'm going to leave to Dirk here. And I think I'm going to stop there. And because some of the things that are on those slides we're going to talk about, and I want to respond to Dirk, who has a much better discussion of it than I did. So there you go.
Thanks a lot, Steve. So Dirk, it's your time to talk about your side, and you can comment on Steve's side too, as you wish.
Very, very happy to. Well, thank you also from me for the very, very kind introduction, and thank you to Steve for this brilliant start to the session. So let me just take a small step back and just talk for 20 seconds about why do we actually care about the CEO hiring stuff or the CEO firm matching stuff. And at least my own take on that is, well, because we have lots of evidence by now from a long literature that CEOs really do matter for firm performance and behavior, and that CEOs differ from each other. So different people run the same firm differently. And if you believe those two things, then suddenly matching the right person to the right firm becomes very, very important. And if we're getting it wrong, or if the market is getting it wrong, then we might be destroying an awful lot of value. So that's kind of sort of why I believe that it's important that we figure out whether the market for CEOs is working well, whether we are indeed matching the right people to the right firms. And at least my own take on that question is that, in all honesty, we don't really know. And quite frankly, I think we haven't done enough research on it. There's a ton of research there's way more research on CEO pay, which I'll probably later argue is actually kind of a second order issue compared to getting the right person to run the right firm. And there are about 10 times as many papers on pay than on CEO firm matching. So I'm thrilled that both Steve and I are working on that. And any academics in the audiences who are looking for a good topic to work on, I genuinely believe this is a very good topic to work on. So what do we know? Jun started out with it at the very beginning. We know that S&P 500 firms and large PE-owned firms hire their CEOs very, very differently. So I'm just going to repeat the numbers that Jun showed us in the very beginning. If we're looking at the S&P 500, and I should say that's joint work with Peter Siraki, who can't be with us today because he's traveling, we have 27% external hires, which basically people are not currently working for the company. But then we argue it's kind of the wrong way of looking at it, because about a third of those are actually current former executives of the firm, or current board members, or current or former board members. So if you subtract those, we're ending up with about 19% actual outsiders. So flip that around, and we have 81% of the time S&P 500 firms are hiring an insider. Then you look at Steve's paper, or the paper by Steve and his co-authors, and you look at these large PE-owned firms, and it's the exact opposite. 70 to 75% of the time we're going after an insider. Now, we sort of kind of knew that. And I think both Steve and I have been looking at this data and been talking to these companies for a long time. So we kind of knew it, but it's kind of nice to just get it down on paper and actually nail it down and show it to other people and saying, look, everybody have a look here. There's something interesting going on. So I think it's a bit of a puzzle, and I'm not going to be able to offer you a grand explanation right now, but I also think it's a genuine learning opportunity. And really what I want to talk about now are potential explanations for what might be going on, with the caveats that I don't know. I'll offer you a bunch of candidates, and then I hope that we can maybe collectively make a little bit of progress on that. Now, before I do that, I want to just show you two more data points, which I think are interesting and informative about hiring in the S&P 500. And I'm going to focus in on these 19% outsiders. So looking at those 19% outsiders, one interesting thing to note is that more than half, about 53% of them, are either current or former co-workers of the hiring firm directors in another firm. Now, in plain English, what that means is when the directors of a large publicly traded company decide to hire an outsider, they very often, more than half the time, hire somebody who they personally know really, really, really well. Somebody they have previously worked with. And I'm sure we're underestimating the number of connections here because, well, we're going to be missing some employment spells, but we're also missing all kind of social connections or charity boards or all kind of other stuff. So there's a really, really strong bias towards hiring people we already know. So if you add that all together, right, 81% insiders, and then more than 50% of the remaining outsiders are people we know, you're ending up with a number greater than 90% of new CEOs that are the firm's current or former executives, current or former board members, or current or former co-workers of its directors. Or very simply, 90% of the time, we're hiring folks who we know really, really well, which is interesting. And frankly, a bit unexpected. We kind of knew that, but I didn't know that the number was that large. So here's another data point that I thought was interesting. Again, these 19% outsiders. You hire an outsider, where do you get them from? You kind of have three possibilities. You can steal another company's CEO. You can steal a below CEO executive from another company, or you can hire somebody who's not currently an executive, which is typically a person who's currently unemployed is the wrong term, who's probably retired from an executive position elsewhere, sort of a free agent right now. So what do we see in the data? Well, more than half the time, and before anybody asks, it's a sheer coincidence, it's again 53%, it's just the universe being funny. So 53% of the time, we're rating a below CEO executive from another firm. About a third of the time, we're hiring somebody who's currently not an executive, and only 15% of the time do we steal another firm's CEO. And remember, that's 15% of 9%. So that's, with a bit of rounding, a little bit less than 3%. So 97% of the time when we're hiring a new CEO, we're not stealing another company's CEO, we're hiring somebody else. I think this is probably most interesting for some of the academics in the audience, because if you look at these frictionless matching models in the style of Gabex and Landier or Turvio, where there's no asymmetric information, there's no firm-specific human capital, there's just this amorphous pool of talented people, that number would be very close to 100%, or in fact, it would be 100%, because all the really good executives are currently CEOs. So if you need a new one, you just steal somebody else's CEO. Now in the data, that's basically not happening. All right, let me go back, and I'm just going to try to do this in 5 minutes and talk about, well, what are the potential candidates for why S&P 500 firms and large large PE-owned firms are hiring so differently. And I think there are really just two types of explanations. Well, different kinds of companies, they're different, they may have just different needs. Or alternatively, well, one or both sets of companies is getting it wrong, is not hiring optimally. So let me spend a minute on the different needs bit and then talk about what's probably the more exciting hypothesis, which is somebody here screwing up. Is it different needs? I want to emphasize before I continue that I don't know really what the answer is, right? The more I'm going to be talking now, the more I'll be speculating in an increasing manner. Now on the different needs bit, I am not convinced. So there are two obvious candidates. We know from the data that the smaller a company is, the more likely it is to hire an outsider. We know the worse the company's performance is, the more likely it is to hire an outsider. So a very simple explanation for the PE result would be, well, maybe those PE-owned firms are just horrible performers and really tiny. Well, we can look at the data and it's just not true. So on the performance side, well, it turns out Steve didn't have time to talk about that. They're actually pretty good performers before the buyout. Average performers are even better. So they're not these basket cases that desperately need an outsider. And if we look at the basket cases in the S&P 500, so the absolute worst performing firms in the S&P 500, they're hiring outsiders about a quarter of the time. So way below the 70% that Steve sees for the PE-owned firms. Is it because the PE-owned firms are tiny? No. First of all, they aren't tiny. Steve is looking at large publicly owned, large private equity-owned firms. And if you look at the smallest firms in the S&P 500, it's still only about a quarter outsiders. So we're never getting anywhere near those 70% that Steve has. Could it be some other unknown difference between these two sets of companies? I mean, that's a tough one, right? Could it be something that we don't know? Yes, obviously, right? It's difficult to rule out. But now it's kind of our job to figure out what it is. Having seen a few other discussions of Steve's paper, people keep going to these restructuring needs, right? Maybe it's just these PE-owned firms have these desperate restructuring needs and that somehow goes hand in hand with having to hire an outsider. It's an interesting hypothesis. I can't disprove it. I don't fully buy it. Because if you think about these worst performers in the S&P 500, their restructuring needs are probably as severe or way more severe than these PE-owned firms, and we absolutely don't see the 70% outsiders. So I don't buy it, but somebody else may provide evidence for it. So let's quickly go to what's kind of the fun bit. Is somebody screwing up here? And if you read Steve's paper carefully, and I've read it about 8 times, that's sort of what they're saying. I mean, they're not going all the way there, and Steve might be kicking my behind in a moment for putting words into his mouth, but they're saying, look, private equity investors have really strong incentives to maximize shareholder value, which I sort of read as they're probably doing the right thing. Well, public companies, public company boards, not so much. So it may indicate that large public companies are maybe not doing the right thing. Now, it's an amazing hypothesis in many ways, and one I'm very sympathetic to, as I'll explain on the next slide, but just the implication is striking, right? Because, I mean, to take it to the limit, maybe S&P 500 firms should be hiring outsiders 70% of the time. They're doing it 20% of the time. So if it takes that literal, then 50% of S&P 500 firms are hiring the wrong CEO. That would be a fun result to nail down. Now, why might that happen? Well, could be because of agency problems, behavioral biases, or external constraints. So let me just run through those in 1 or 2 minutes, and then I'm going to hand the floor back to Jun and Steve. Agency problems. And I want to emphasize, I'm going more and more out in speculation land at this point. Is it agency problems? I do believe that agency problems play a really big role here. Just put yourself into the shoes of a typical director of a publicly traded company. Your incentives, your payoffs when you're hiring a CEO are very asymmetric. If you screw up, if you hire a bad CEO, especially somebody who needs to be replaced quickly, it's incredibly painful. There's a massive reputational cost, but also just the process of having to fire somebody, doing another search and everything else is super costly. On the other hand, if you hire an absolute superstar, well, frankly, very few people are going to remember that you did. Everybody's going to admire the superstar. Very few people are going to remember that you did. And your financial upside is really, really limited because the typical outside director in an S&P 500 firms doesn't have much equity exposure. So I think it's rational for a public firm director to be very, very conservative and kind of go with the proven entity rather than risk something in the hope of finding that amazing, outstanding CEO. And I believe the incentives are much better aligned for private equity executives, private equity partners sitting on boards because they have a much bigger upside. So I think agency problems could be a contributor. If you have a minute later, maybe we can talk a little bit about headhunters who also play a role in especially hiring outsiders. And I believe their incentives are also not well aligned with long-term shareholder value. Could it be biases? Look, there are tons of biases that we all suffer from. There's an endless psychology literature that we says. And sort of my personal test of whether psychological biases, things like familiarity bias, status quo bias, ambiguity aversion, all of which would bias you towards hiring the known entity, right? The people you already know. I think a useful test to think about whether biases might affect behavior is always, well, how easy would it be for people to figure out that they're getting it wrong? How fast is the feedback? How fast is the learning that would allow people to correct their behavior? And in the CEO hiring realm, I think the feedback is incredibly limited. I mean, you don't ever get to see the counterfactual, which is academic speak for you don't ever get to see the same company run by the other person, the one you didn't hire. Learning about match quality is really slow. When you hire a CEO, things go well. Is it because of the CEO or 100 other reasons? Very difficult to figure out. And CEO turnover is rare. So even if you've been a director for 10 years, you might have seen 1 or 2 CEO turnovers. So just sort of structurally, this is a setting where I think biases might really play a role. And then just to conclude, and Steve talked about that already, so I'll be going to be super brief, thinking about external constraints on firms. I mean, it sounds almost ludicrous. The hypothesis or the claims that public firms, the ones that are paying 10, 20, 30, sometimes 100 million a year for their CEOs might be constrained from paying enough for talented outsiders. But here's an important, I mean, first of all, let me say something obvious, then I'm going to give you one data point that Steve already gave you. There is a ton of pressure on public firms these days from employees, the public, and even shareholders to not overdo it on CEO pay. Just think CEO on pay, think ISS, think all of the pressure on remuneration committees and boards. And the very simple data points that I just want to mention again is that, well, Steve's just shown us that the PE-owned firms pay a lot more. And frankly, it is a lot more. I mean, these basically S&P mid-cap sized firms are paying almost as much as S&P 500 firms. I mean, that's a big gap, right? They're paying about twice as much as the public companies. And then one data point that Steve already mentioned, which is from a different country, so may not apply. With my course as Alex Edmonds and Tom Gosling, we did a survey of directors in the UK, people on remuneration committee, and in a nutshell, they're basically saying it is a major problem for us. 77% of them are saying that external pressure from exactly these parties, but interestingly enough, especially from shareholders, forces us to pay less than we think is optimal, and optimal in the sense of maximizing shareholder value. So those practitioners believe that those constraints are very, very real, at least in the UK. All right, I hope I didn't run over too much, and I promise to shut up now.
Thanks a lot, Dirk. So there are several questions in the Q&As. If you have additional questions, feel free to send in your questions through the Q&As. And also, we have received a list of questions from the audience at the registration side. I'm going to incorporate some of these while I'm asking questions of our 2 outstanding speakers. So the question from Claudine is very much in line with the question I have in mind. So this is number 3 for today. What about a third-class explanation that the owners of public and private firms have different styles and competence? Public firm owners are good at engagement, investing in firm-specific information, while PE owners are good at efficiency styles with advantage CEOs that are good at cost-cutting playbook. So the same firm, different owners, different strategies both viable? So my question from this is, to what extent the differences we observe is driven by the constraints the firms are facing, as Dirk mentioned, and to what extent is driven by the different need of different managerial skills or traits of these two different type of firms. So you can go on to talk more about perhaps, so there are several questions on that side. What would happen if a PE-backed firm goes IPO, or what would happen to the CEOs after a buyout? So I'm going to start with Steve to address the serious questions related to the differences we observe across these two types of companies. Steve.
So I think, the answer is, it's a good question. We're not sure. I would err on the side of saying they're less different than you think. And here's why. When the buyout firms buy a company these days, they're not the cost cutters they were in the 80s. They're focused on growth. You ask a private equity investor what he or she is looking to do with their company. They do want to make them more efficient, but they want them to grow more, because how do you make money as a private equity investor when you sell the company? You get paid for growth, right? If you just look at free cash flow over R minus G, you can raise the value of the company by increasing G a lot more than by increasing the free cash flow. So the CEOs that the PE firms hire, they actually want them to grow the business, which is what you're talking about in the public company. So that's one. Two, I've done a lot of work with GH Smart, which assesses CEO talent. And I always ask them, is it different for CEOs of public companies versus private companies? And they basically say a little, but the key drivers are pretty much the same that they look for. And then you talk to headhunters too, who I think actually, Dirk said their incentives are to get paid, which is to find a CEO. But I think in the medium term, they do care if they make good matches, because if they make good matches, then they're going to get more. They can then go market, hey, we made a good match and made a good decision and helped you do that. So I think the headhunters I talk to are actually do want to make good matches, and so are incentivized. So I will that doesn't explain why there are more insiders than outsiders at the public companies. But long story short, I think the skills that you want in these companies, whether it's public or private, are more similar than they are different.
Yeah, I think I in essence agree with everything Steve just said, which is probably boring. I'll look for some disagreements in just a moment. I genuinely don't. I mean, again, if you go back to the 1990s, I think the PE-owned firms were much more selected and were much more special and were much more different from the typical publicly traded company. But private equity has grown so big, and Steve showed us the data earlier, you can't do that anymore. Right? I mean, these are sort of pretty much run-of-the-mill companies that are owned by PE right now. They own growth companies, they own value company, they still own restructuring cases. Now somebody, and whether that's Steve and his co-authors or somebody else, kind of needs to nail that down a little bit more precisely. I'm pretty sure Steve's and my intuition here is correct, that in fact they aren't that different. We can kind of look at that, right? We can try to do a much more careful matching between publicly traded firms and private equity owned firms based on prior performance and industry and everything else. And you can even sort of do the unfair thing and look at subsequent growth and everything else and really try to pick up firms that are at the same stage of their cycle of restructuring or growth or what it may be. And I'm pretty sure you'd still find a massive difference in hiring between the two. I really don't think it's easily explained by observable differences between the two. And another data point, just picking up on something Steve said, Steve has done this amazing work on sort of the skill requirements or the skill set private equity owners are looking for when hiring executives. There's some interesting work by Stephen Hansen, Rafaela Sadun, and co-authors, where they're looking at job descriptions for public company C-level executives, including CEOs. And it doesn't look that super different. And in particular, the sort of emphasis on social skills and the growing importance of social skills, you basically see on both sides. Now it's kind of interesting, right? When I saw that public company firm research on all social skills are incredibly important, are increasingly important, I'm thinking, well, those are very, very difficult to observe in many ways, right? So you can kind of observe hard skills. Is somebody a good finance person, a good accounting person? Does somebody have a certain education? That's relatively easily observable. Whether somebody is a good leader in interpersonal interactions, that's much more difficult to observe. So I kind of thought, well, that might explain in part the bias towards hiring insiders or people you know, even in other companies. But then again, I'm looking at Steve's sample and going, well, but the private equity-owned firms also very, very much want social skills, and still they're going to the outside. Maybe to say something a bit constructive, something that I would love Steve and his co-authors to do, and I've said it before, Steve's heard it from me before, is to look at to the extent that it's possible, to what extent do the private equity partners know the people they are hiring for these private equity owned firms? So we have this result for the public firm directors that if you go outside, you kind of hire somebody who you know. And having presented my result a bunch of times in front of practitioner audience, including PE people, and I've always mentioned Steve's result as well to kind of make it more interesting. The PE guys are the least surprised by Steve's result. Right? They're saying, look, that's what we do. That's our job. This is one of our big value added, is finding good people to run these companies. And one person once told me, very senior partner from Bessenheimer said, look, I'm basically a walking Rolodex. I know people and I match people to companies. That's what I do. And I think that's a wonderful model. And that may well be one of the big value added actions that private equity people bring to the table. And I think, again, it would be wonderful for us to nail that down, basically saying they have this amazing Rolodex of people they know they've worked with elsewhere, and they're shuffling them around optimally between companies and kind of improve the matching of executives to firms.
So I would say on the knowing, we're working on that, Dirk, to try to figure that out. And it's going to be, I think it's going to be much less than what you found on the public company side, because they will not, they're out just meeting people, and they haven't necessarily worked with them, but they know about them. Like I wrote a case on a company called Zayo that GTCR invested in, and GTCR, their strategy is they pick industries they like, and then they look for the best management team in that industry. And when they invested in Zayo, they hadn't worked with Dan before, but they'd met him, they talked to him, they knew him, but they hadn't really worked with him. So I think that would be considered for you a pure outsider. But so, and I think that is more typical. They do now have operating partners who they've worked with, who they keep putting in, but they go for true outsiders more than, I think that result will hold, but I'm working on it.
Yeah, I mean, and again, just to be clear, right, I wouldn't view this in any way as a criticism of your result. It's more that sort of the notion of, I mean, I would still view this as a true outsider by our definition, right? Sort of just the notion that it's very much the job of a PE partner to know tons of good executives, however they get to know them. And that's exactly what they're doing. And they're kind of building up this Rolodex of talented people that are with the notion as maybe I'll try to hire that person at some point in the future, be it 5 years later or 10 years later. It's obviously when it's at that level of just sort of meeting people, I don't want to say loosely, it's for us researchers, it's very, very difficult to nail that in the data, right? Maybe do a survey, right, of those guys and ask them, how did you actually know that person? Do it case by case, right? Kind of go back. Why is that person? How did you find that person? It would be potentially very interesting.
And I would say, like, one other point that's important in this discussion is that I think that there was this discussion among people whether firm-specific skills mattered more than industry-specific skills. And I think what I'm pretty convinced about is, like, the industry-specific trumps firm-specific. I don't think firm-specific is worth nothing, but industry-specific, given that all the people who get put in, whether it's an insider or an outsider, know the industry, that's the key thing. You got to understand the business. And I think if you don't understand the business, that's a problem.
I mean, industry-specific skills definitely matter. I'm very sympathetic to what Steve said, but then let me go back to my Peter with Peter Siraki and saying, and now we kind of need to understand why the heck are they doing 80% insiders in the S&P 500, right? If firm-specific human capital doesn't matter that much, then why do they keep going back to their insiders, to the folks inside the firm?
Because what the headhunters tell me, so I asked this doesn't work for the smaller companies that are public where you see the same thing, but the larger companies, at least you can make the argument that they're big, there's lots of talent running around. So the best person internally is going to be pretty good, and maybe they are not as good as the best external one you can find, but the difference is not large. And then because there are frictions, getting somebody to move, getting, maybe having to pay them off in their other company, their options or whatever, whether they're CEO or not, that you can do pretty well in a big S&P 500 company by hire internally rather than going externally. I think that doesn't work once you get to like the mid cap or the small cap, where it still, that doesn't, then they're going to be more similar to the private equity funded companies.
Yeah, so I'm sympathetic to that, right? But it is sort of, we know that from your results, and if you sort of cross-read some of John Graham's prior works, that there's still going to be not a 50 percentage point, but like a 40 percentage point gap between your firms and the S&P mid-cap firms. So we still have a ton to explain. And since we're a little bit supposed to talk to junior scholars, you don't need to be junior to do it, but junior scholars are more likely to have those skills. I think neither Steve nor I do have it. I mean, the model that Steve just laid out, right, where, look, you're a larger a company with, let me make up some numbers, 200,000 employees, is likely to have somebody within the firm such that even relatively small frictions, firm-specific human capital, search costs, asymmetric information, would make you go inside, choose an insider, while a company with, let's say, 20 or 30,000 employees is more likely to go outside. That's that model that calls for a structural estimation, right? That basically says, look, if that's what's going on, we can try to nail down in a model what that tells us about the scarcity of human capital, the scarcity of general human capital, the scarcity of firm-specific human capital, the importance of these two factors. And then, and that's sort of where then gets exciting, let's think about CO pay. Right? Because sort of the way where, or the one point where I'd like probably poke Steve a little bit is saying, well, look, I'm very sympathetic to that argument, but it sort of implies that awesome general skills aren't that rare, right? It basically means that, look, once I have 200,000 or 300,000 employees, I'm going to find somebody who's pretty awesome on that general skill thing, such that I don't need to look outside anymore. So then even a little bit of firm-specific human capital says, okay, fine, just hire the insider because they're already pretty awesome. It sort of flattens the awesomeness on general skills, kind of flattens out. We're now in a very different model from these frictionless matching models, which do such a wonderful job of explaining very, very high levels of CO pay. But I haven't seen that model yet. And I just unfortunately don't have the skills to write that model down by myself. But lots of other people do. And I would really, really, really like to see that. Basically, a model that basically just said, look, you've got these two types of skills, smaller firms, bigger firms. Let's match what we see in the data, and let's see what it tells us about the demand and supply for these two different types of skills. I think that would be really interesting to see.
It's interesting.
That's a great suggestion for the brilliant young minds already. So let me echo some of your discussions from the audience. Dr. Ira Kay, thank you for coming to the series again, has a comment. Dr. Kay is a very established compensation consultant. What Dr. Kay said is great studies. My experience in that public companies are under enormous investor and governance pressure to groom and promote internal CEO candidates. And public companies have a number of positions, incumbents to pick from. PE are not under that pressure and do not have a big internal bench. So Steve, I'd like to see, how do you view that? And I will follow up with another question for Steve.
I mean, that's a little bit the selection story. And Ira is someone I know well and is probably a friend. So that's it's a good question. I think for the big companies, I mean, that was the argument that I just made with Dirk, and I think there's probably some truth to that. I think the smaller companies, you know, it's a little harder. It's also harder if you look at public to private. So the public to privates that are done, the private equity firms do replace them with outsiders. Now, maybe it's a selection issue where the ones they took private were the ones where they decided they were going to replace the CEO. So I think there's some truth. His story, that story is both an agency story and an efficiency story. So there's a little bit of both, that the pressure is on incumbents, you know, internal people, so you're going to develop them. So that's an efficiency story. It's also a little bit an agency story, that if you don't do internally, you know, then, you know, there's some negativity rather than going after the best person. So I would say I agree with Ira. I'd say I'm not sure what it means, because it could go both ways.
All right, so there's a related question, two related questions. I don't know who is going to answer this question. The first one is from Tom Gosling. So this is probably Dirk's co-author. For the external hires from S&P into PE CEO positions, how many were CEOs in S&P, or they are just mainly executive officers? Do you have any idea about that?
I have that. It's in one of the tables in my paper.
Okay.
And I think it's more, it's a good question. It's more they are running divisions of big companies. So there are a few examples of that, but of CEOs of S&P 500 companies going to private equity, but it's much more you're running a very big division of an S&P 500 company. You're not CEO yet. They pick you off and make you CEO of the private equity funded company.
Dirk, I have the mirror question for you. I don't know whether you know the answer is, so for private companies, if they go public at some point, do you follow the public companies back to their IPO stage to see the CEO turnovers? And what kind of patterns do you observe if you have done such a research?
No, we have not, is the short answer, but somebody should. So if we have time at the end to talk about research ideas for other people, that is on my list. Okay. And I believe I did discuss Steve's paper at the last AFA meeting. And I believe one of the suggestions I made back then was, well, why don't you track your firms a bunch of years before and a bunch of years after? My hypothesis being that these PE-owned firms probably behave like publicly traded firms before and after. So there's really something special about being PE-owned. So my hypothesis would be they're sort of reverting back to mostly promoting internally. But no, we haven't done that yet. And somebody absolutely should. So this is an absolutely great question. In some sense, I can summarize, I think, the research agenda here. We sort of have two, I don't want to say random, because we obviously picked them for very good reasons. We have now done this research on two sets of firms, the largest ones, because that's kind of always natural to start, and then PE-owned firms, which are A, very, very important, and B, really, really interesting. And we think many of these agency problems are much less pronounced, therefore also interesting to look at. There are lots of other sets of companies out there, right? So we need to see that kind of research, which in many ways it's very simple, right? Just a bunch of data collection, a bunch of summary stats. We need that kind of research to be done again and again and again. And yes, track companies over time in their life cycle, look at non-PE owned private companies, look at other countries, and on and on and on. I really would like to see those very simple statistics for kind of every possible company in the world. And then we can collectively think about where the differences come from and why different types of firms do it differently. But I believe we're very much at the beginning of this journey. We've done way too little of it.
And I would say that, you know, one place to do that, and I don't think anybody's done, is venture capital backed companies, because we do know there's also movement there where they will, it's not the founder, but when you replace the founder, in a number of cases, you know, and this is be later stage or growth, you put in somebody who has larger company experience. And we know a lot of that happened in the dot-com era. That didn't end well, but I'm sure it goes on now. And I don't know how much. That's actually it's a good question, and don't know the answer.
Yeah, no, it's a great question. I was discussing it actually with VC scholar exactly that recently, and sort of just passing on It's definitely still going on, but apparently quite a bit less so, right? This entire notion of there was just a ton of venture capital money chasing deals, and sort of the bargaining power, certainly what the VCs are claiming is that the bargaining power has kind of shifted towards the founders. And that makes it more difficult to kick them out, right? So that was kind of one of these sort of earlier pressure points. You want another round of funding, but we're going to replace you by somebody who knows what he or she is doing. And now there's just too much competition. So you have a lot of founders who kind of stick around and entrench themselves with.
No, Dirk, the bargaining power is now shifted again. So 21
enough. I may be a couple of years outdated on that view.
You're a couple of years late. Now the bargaining power is back at the VCs. So
that's amazing, but it's wonderful, right? That's amazing research opportunities right there. If we see that changing over time, that would actually potentially give us some really useful variation to also kind of see which one works better. I mean, I think we both have sort of our biases that would saying bringing in the professional is probably the right thing to do at some point in time, and having the founder hang around with dual voting stock for the next 15 years is not. And there's a little bit of evidence on that already, but I think I hope to see a lot more in that regard going forward.
So now we see some sparks, right? We see some fireworks. That's great. So I have two questions. They are related. One is from Miriam at the registration side. She asked, how do founders and funds rights change when firm become public? I think the question is more general. So when the founder departed from the company, what made that affect the CEOs or CEO selections? This is one of the questions. How does the founder affect CEOs? The second one is related, that's from the audience, asking to what extent the phenomenon we observe in PE-backed firms are not driven by private firms, but by the ownership of private equities. So I'm not sure whether, Steve, you can really distinguish the two. It's more of ownership structure rather than just private firms.
Yeah, it's much more. I mean, I think it's ownership structure rather than private firms, because private firms, you know, family businesses, you have a lot of things. So the thing we studied was private equity owned. And so now the question is what happens afterwards. So I think there are a lot of different permutations. So one, a lot of private equity deals are sold to other private equity firms, in which case, you know, the governance is basically the same. Some of the private equity deals, they sell to a strategic, in which case, you know, then you've got the strategic governance, which is, you know, in many cases a public company. So that is the, you know, 2. 3, the private equity firm funded company goes public. And that's probably the third most frequent after the first 2. The first 2 are more frequent. And then I think once they go public, and I think Dirk said this, the buyout firm investors tend to go off the board over time, and then you get more governance that's going to look probably more like public company governance. And that's why, you know, Dirk suggested doing that study. I think we don't, you know, at least with the sample I had, I don't think we had enough time and enough observations to do that, but it's a very good suggestion. So I think there's all these permutations, so it's hard to have a one size fits all on that.
So we probably do have another new project coming
there are many projects. That's the good news.
That's great to know. So there are still many questions from the audience, both before the lecture and during the lecture. So I'm going to pick a few to ask both of you. One particular question is, how do the findings of your research projects, I know we're talking about 2 in particular, but both of you have studied CEOs forever, probably throughout your entire career. So how do these findings influence the promotion of more diverse CEOs in both public, we may have a little bit more ideas, and private companies? So Dirk, would you like to start with that?
Yeah, I'm happy to take that one. And again, I want to emphasize this is a bit speculative, obviously, but I think one of the insights that comes out of I think certainly our work, and I think to some extent probably also out of Steve's work, sort of asked about that earlier, is that knowing the person you are hiring is playing a very, very important role in CEO selection, certainly for these large publicly traded firms, but I wouldn't be surprised if across the board. And I want to emphasize, but just sort of as a little aside, that's really just saying that top executives in some sense aren't that different from hiring in any other labor market that has ever been studied. Right? Go to any labor economist and ask them about whether personal connection, personally knowing the person, plays an important role in pretty much any labor market out there. And there's an enormous amount of evidence that that's absolutely true across the entire hierarchy. So in some sense, we're really just saying, well, look, top executives aren't that different on that dimension. You kind of want to know the person you're hiring. Now, if that's the case, well, being known, if you sort of want to turn this into career advice, which I was recently asked in a different discussion, can you turn this into career advice for somebody who wants to be a CEO? Well, yeah, you kind of want to be known, right? You want to be known by top executives, by directors, by the people who make these hiring decisions, and by headhunters, because they also play a very important role here. So there's a certain danger in that, obviously, if we're worried that kind of people of a similar type, similar socioeconomic background, maybe similar gender, are more likely to know each other, right? So if you want to kind of make it more, sort of want to say the negative side of it, it probably means that you have if you have an unusual background, if you have the wrong gender, aka you're not male, then you might not be as well connected, might not know as many people in those right positions, the people who make the hiring decisions. And if being known enormously matters, and that's an issue. But obviously then to turn that around and make it constructively, and we've got initiatives here at LSE, and I know lots of other business schools in the US do that as well. It kind of means, well, then we know how to solve that problem, right? Kind of try to improve the networks of minority candidates and others, make sure they are known by the right decision makers. And if indeed what I described is the friction, it's going to help and it's going to alleviate the problem going forward.
That's great. Thank you, Dirk. Steve, do you have anything to add to this, or I should move to the next?
I would say two things. First of all, Morten Sorensen and I have worked on, what CEOs look like. And again, we use the GH Smart data. And one of the variables that comes out as mattering for being a candidate is something we call charisma. But it has the characteristics that I think Dirk is saying, where you're persuasive, you're proactive, you're sort of out there. So I would just concur that the data are consistent with that. And I think that's something you can probably work on, although again, that's actually a question for research. I would say on the private equity side, where I think it's less, they're less about who they know and more about looking for people who are going to add value. And so to the extent that, you have somebody who's more diverse or different, who's creating value, that's going to be attractive. So I think the private equity investors are, they certainly hear that from their LPs to look for that. And they're, whether they can find it or not is the real question.
Thanks a lot. Thank you, Steve. I want to make a really quick comment. I know the profession has done quite a bit to improve the diversity, at least in the finance field, and guide junior scholars, like the AFFECT, which is affiliated with the AFA. So you tend to have sessions before the AFA, before the WFA, to have mentor system to assist young scholars, especially women and underrepresented minority. I think there's probably a long way to go. So let's see if we can help in our profession. There's another question. This one, Steve can talk for about 2 hours, so I'm not going to let you talk for that long. This is about CEO compensation. CEO has many research on CEO compensation, did consulting and talk before the Congress and the Senate about it. So the question is, what you mentioned that the total amount, right? But I'm going to push you a little bit further on that. How does each type of firms, so now I'm talking about the private and maybe public later, design executive compensation programs, and specifically the long-term incentive plans? So you mentioned for these PE-backed companies, the CEO may have 2% of the company plus some $2 million salary. So can you tell us a little bit more of your understanding of the compensation plan and how this might differ from public company CEOs?
So this, I have very good information on, because I actually looked at the data, and I also survey my private equity investors. I have a group that I meet with, twice a year. And I, after I wrote this paper, I said, have I got this right? How do you do it? And so basically what they do is there's a salary. The salary is probably on the order of $1 million a year for one of these larger companies. Then there's a bonus, and that bonus is generally tied to EBITDA and maybe sales growth. And that's also on the order of $1 million a year for these companies. And that's actually not all that different from public companies, although it may be a little bit more tied to EBITDA and performance than the public companies. And then the third piece is they give them, a fraction of the company in options or RSUs or some form that is on the order of 2 or 3% for the CEO. And that vests over 5 years or when they sell the company. And sometimes there's a performance-based piece to it that it's higher if the performance is better, lower if not. But that's basically it. And that 2 or 3%, that is pure performance-based. If the CEO is fired, he or she loses that. That's gone. If they stay, then that turns out to be worth quite a bit. And I think that the PE investors also, when you talk to them and they're thinking about, putting them together, they do think about here, if things go well or go according to our model, here's how much the CEO is going to make. And that's going to motivate him or her. And it is very, very pay for performance based. The public companies do better than they did, 20 years ago, but it's going to be more performance based than the public companies. And I think this also, I'm going to come back to something Dirk said earlier about Europe. PE in Europe has done pretty much as well as PE in the US, which is different from venture historically. And I think the reason is they're getting a great selection of executive because there's even more pressure to keep pay down in Europe than in the US. The US companies actually do a better job. Ira's listening, so I can say that because he advises on this. The European companies, not so much. And I think that drives people to PE and actually helps PE quite a bit in Europe.
All right, Dirk and Steve, I think it's almost time. So I would end our talk with 2 things. One is each of you may have up to 2 minutes, but only 2 minutes to say your open questions. Dirk might have already mentioned a few for these young, brilliant minds for the future research on CEOs.
Steve, you want to go first?
We've talked about them. I think it's still an open question, and you heard this, from Dirk and me about the public companies and the private companies being different, particularly private equity funded companies. I think that's an open question. I think we talked about the venture capital funded companies, which are another group where we don't know a lot, and I kick myself because maybe we should have done this already. Question number 2 is, what actually makes a good CEO? And obviously I've done work on that with the GH Smart data, but and Dirk has done some work on that, but I think we don't know. And it's hard to get the right data, but if you can get the right data, that's like a really, really interesting question, and has huge implications for practice as well as research. And I think the last question is how situation specific. I always hear this, like, is a great CEO here, would that CEO do the same in a different situation? And that's also very, it's hard to measure, but it's I think a very interesting question.
Thank you, Steve. Dirk?
I think that's perfect. Again, I'd emphasize all kind of sets of firms. And I think the big hole there we really know very, very little are non-PE owned private firms. And in the US, that's almost impossible to do that research because you can't get the data unless you have some magic census data. Maybe somebody can do that. But there are many other countries where you can do that research, right? In France, in Scandinavian countries and other places. So I think somebody needs to look at that. And Steve made several very interesting, and I think entirely accurate statements about pay in venture capital backed companies, in PE owned companies, but we don't really know it, right? Steve kind of knows it because he talks to them, but nobody's able to write a paper about it because we don't have that data. And I think the more data we could extract there, which would have to be survey-based or some other magic approach to getting that data, would be extremely useful to really understand those differences. I mean, Steve's statement about PE, the gap between pay in PE-owned companies and public companies being wider in Europe than in the US, I believe he's entirely accurate. I'd love to show that in the paper. I don't know how to. And it would be wonderful if somebody could figure that out. And then maybe just the final point, and maybe a little bit too nitty-gritty, but I'd really just like to understand the selection process in publicly traded companies a lot better. Right, so Steve's done some wonderful work for privately held companies, but Ira Kay mentioned earlier that entire notion of succession planning and all that pressure public companies are under. So they're now all doing succession planning. It's entirely focused on insiders. There's a bit of lip service to, yeah, we're kind of thinking about a few outsiders as well, but practically it's entirely focused on insiders. And then in the end, you end up promoting an insider, which probably isn't all that surprising. And the pressure is coming from institutional investors, right? So the entire notion that somehow institutional investors are unhappy with what they're doing can't really be the case. So I think there's lots of interesting work to be done there.
Thanks so much, Steve and Dirk. I think we should have 3 lectures with the 2 of you, but our time is up. This is 1:15 Eastern time. So I really like this fireside chat. I really appreciate your sharing your insights. I know you have a lot more. For example, Dirk can still talk about CEO replacements. You have multiple projects on that. And Steve can talk about CEO pay, whether that's too high, too low, what's the structure. I really enjoy your early presentation on the celebrities, lawyers, or other top talents. So we have to stop here for this lecture. Thank you all for coming. On the screen, this is the QR code for our next lecture by Nadia Malenko on shareholder voting. Thank you. Thank you for coming. I hope to see you next month. Thank you, Steve. Thank you, Dirk.
Thank you very much. It was fun.
Thank you very much for having us. Thank you, Steve. This was great.
Thank you. Bye.
Bye-bye.